joined by Martin Pelletier, Senior Portfolio Manager at Trivest Wealth, Wellington-Altus Private Counsel. Martin, thanks a lot for joining us. What's your take on this news from that was reported in the Wall Street Journal, which seems to have been borne out today, that a 25% tariff is not going to be slapped on Canadian products as of today. Instead, Trump will take a deep look at the trading relationship between Canada and the U.S. and other trading relationships as well.
So 3 main takeaways from today. First of all, no mention of Canada in the inaugural speech is a very good thing. Constant threat of tariffs still is looming and will undermine investment within the country, and it's going to be an overhang. And thirdly, it's complicated. The trade between our two countries is highly integrated, and so it's not as simple as it sounds. When you strip out energy, for example, the U.S. has a $58 billion trade surplus into Canada. The U.S. Imports 60% of its crude from Canada. Of that, of the 4.4 million barrels a day, half that goes into PADD 2, which is not highly substitutable with the type of crude that we're delivering. And then you look at the U.S. itself. You look at companies like General Motors. Their pickup trucks sold in the U.S., half of them are imported from Canada and Mexico. GM is a U.S. company. And so it's not as simple as it sounds of just slapping in a 25% tariff across the board. And so taking some time to understand the trade relationships is important. And it's also good for us as Canadians because we don't have a functioning government right now. And so we're kind of drifting in the wind. So getting more time is beneficial for us as a Canadian.
I know this country has said no to a couple of prominent pipeline proposals over the past decade or so, and I know you've got some thoughts on where we would be today if Energy East had been built, which would have taken crude oil from the west to east, or if and from the east to a refinery in the east, and therefore off to Tidewater to non-U.S. markets, and Northern Gateway, which would have had a similar effect on our ability to sell crude oil to non-U.S. customers. We do have one new pipeline which is capable of facilitating those type of sales. It's the Trans Mountain Pipeline expansion. But how different would things be if we had Energy East and Northern Gateway constructed by now?
Be vastly different. We wouldn't have the hostility between provinces more directly towards Alberta in regards to threatening to cut or withhold oil exports into the U.S., which is our only customer. If we had more customers and more markets to ship our crude to, that would be a very large hammer to hold in trade negotiations instead of trying to punish ourselves or one particular province. And so having an Energy East providing discounted crude instead of to the U.S. to Eastern Canadians and expanding some refinery capacity out there. Northern Gateway getting our oil to international, to Tidewater and in the international markets would certainly be a very beneficial trade tool. And so I think this is something that we really have to consider going forward over the next 4 years, is maybe instead of building more pipelines to the south, which I'm hearing the Trump administration is very eager to do, despite the threatening of oil tariffs, instead of going down that path, maybe we'll look at, as a country, trying to find new markets, not just for energy, but other trade as well, too.
So there's been a sigh of relief today in share prices. We've taken our viewers through the energy stocks rising, Bombardier stock rising, Canadian, one of the big rail stocks, Canadian Pacific, Kansas City, rising as a sigh of relief that a giant tariff wasn't slapped on our products today. But how should Canadian businesses and how should Canadian investors be thinking about this issue over the next 4 years?
Well, it means more volatility. That's for certain. You certainly want to be in segments of the market that is going to be protected from some of the tariff exposure. Those sectors like metal sector, food and beverage manufacturing, chemicals, machinery are still highly exposed, and more so than energy, for example. If you look at energy in particular, we are selling our oil at a discounted price to the U.S., and that's very beneficial to them. And low gasoline prices for the citizens there. And so should we see a sell-off in the energy space, that could create an opportunity, as we're seeing today with MEG, for example, and CNQ. If you're looking at other segments, then, again, be a little careful about where you think those tariffs are going to be, because there's going to be some volatility.
We've got about 60 seconds left. Are you making any portfolio changes on this news? Are you adjusting your Canada-U.S. equity market allocation, for instance, on this type of news?
Well, we were more bullish on Canadian valuations and the Canadians' TSX heading into the year, and just based on, again, valuations and the disconnect between it and the U.S. We haven't really changed that per se, although we are maintaining our U.S. equity exposure. So I guess we're just holding the course, staying the course, and being careful about our exposure to those segments of the market that could have that tariff exposure. Albeit, I think the energy sector is fairly safe. So we would be looking to add to some of positions in energy should they reverse course from today and sell off.